Hello and welcome to our Scotland and Northern Ireland Off the Road webinar. I'm Kenny Boyd, the Business Development Manager for the region. We were out and about last week taking our on-the-road sessions across the UK, and we're delighted to have hundreds of advisors and power planners come to join us at the events. We even had to arrange a larger venue for the Edinburgh session due to the high number of registrations. We understand that many of you were unable to join, and the need for online content is in demand. So we've arranged this catch-up session to ensure everybody gets to hear our sessions. A copy of the recording will also be available at the end of the week, so if you'd like to recap or pass on to a colleague, please feel free to do so. We'll supply the link to the recording after the event via email. This session qualifies for structured CPD time and will supply your certificate based on your time in the session via email in the coming days. We'll also send you a copy of the slides. I'll be joined today by a number of speakers, including AJ Bell's Investment Director, Russ Mould, Senior Technical Consultant, Lisa Webster, Investment Business Development Manager, Andy Adshead. I'm also pleased to welcome our guest speaker, Mel Holman, Managing Director from Compliance and Training Solutions, otherwise known as CATS. For now, however, I'll kick off the session with a business update and what's been going on here at AJ Bell Investcentre. Our on-the-road seminars in the region were well attended, and it was pleasing to see some new faces attending the session as well. So for that reason, I started the presentation with a brief introduction to AJ Bell. We're a FTSE 250 company, and we're one of the fastest growing platforms in the UK. We've also grown to over £76 billion of assets on behalf of almost 500,000 customers. We have a 4.8 out of 5 rating on Trustpilot, and we also have a 95.5% client retention, which is very strong for the industry. As you can see from this graph, we have steady year-on-year organic growth from advisors like yourself, so thank you for the continued support. You can see we continue to have strong net inflows at a time when many platforms are seeing large outflows of assets. You can also see on the graph on the right-hand side, AJ Bell Investments continues to grow and are now through the £5 billion mark, with again strong net inflows, which is testament to their strong and consistent performance. This growth and profitability allows us to continue to invest in the proposition, and as you can see from the chart on the right, our technology spend has gone up by 29%. We also continue to enhance our operational support with an increased spend of 14%. Our customer services team in Manchester continue to do a fantastic job, with 92% of calls answered within 20 seconds. Also, large volumes of emails come into the business, and 95% of these emails are answered within 24 hours. A large part of that technology spend was enhancing our client onboarding journey, which many of you are now using today. This went live in January this year, and we can now produce fund-specific illustrations detailing the costs and charges relevant to your client's portfolio. It's a huge step forward and also includes pre-populated application forms should they be required. We've continued our integration with Origo. So the system will tell you if the transfer is going to go through the Origo system, and it'll give you a green tick. This means that we do not need a transfer application form scanned through. If for some reason the transfer is not going to go through Origo, then the system will tell you and produce a pre-populated application form at the end of the journey. This will be able to download in a KID file beside the client's illustration, KID documents, terms and conditions, key features. So all in all, a large time saving when it comes to producing your illustrations. In October, we also had system development, so you can set up withdrawals and closures online. And in January, we also made it available for advisors to update clients' nominated bank account online as well. So another huge step forward. The platform remains one of the few multi-generational savings platforms with full suite of junior products available, being Junior SIP, Junior ISA, Lifetime ISA. We also offer entity GIAs for third-party pensions, charities, limited companies, trust cases, and also offshore bonds can sit in our GIA from Canada Life International and Utmost. There's a wide investment flexibility on AJ Bell Funds and Shares service with more than 4,000 unit trusts and OICs, ETFs, investment trusts, equities. We can also buy gilts as well through funds and shares. So we're seeing a large increase in advisors looking to buy gilts directly with us, which isn't always available on other platforms. We're also paying up to 3.15% interest on our SIP cash and funds and shares cash. And contrary to an article that was recently released, we do not take any platform charge. Just to recap, we do not take any platform charge on the cash sitting in SIP cash or funds and shares cash. There's also a demand for cash from clients over the difficult market conditions over the last 2 years. So on AJ Bell, we've seen a lot of interest in fixed term deposits, trustee investment plans being able to be added on, for example, Pru tip, LV tip. But with this demand for cash, we also launched our own money market MPS in December last year with no investment management fee. This is really to help protect clients looking for another solution for cash, with the current yield being 5.17%. As you probably know, on AJ Bell Investcentre, you can also have dual investment strategies. So the money market MPS can sit alongside your normal investment portfolio. So we can have 2 investment strategies under our SIP, and you can up to 4 investment strategies under our ISA. One development we're looking at for this year is also to extend a multi-investment strategy within our GIAs. More to come on that. Last year, we also extended the range of third-party MPS providers, so we now have 15 available for you, alongside AJ Bell Investment, where we have different investment styles being passive, active, and a blend being passive MPS. We're also seeing a large increase in people looking at the fund option within our GIAs for CGT reasons, and we are seeing strong inflows into the funds due to its capped OCF of 0.31% and strong and consistent performance. The funds and MPS are all risk mapped to the main risk profiling tools. Due to the yield that's currently available on our AJ Bell Income Fund and our Income and Growth Fund, we're seeing a lot of interest in our retirement portfolio service for your decumulation clients. If you want to know more about this offering, please do get in touch with myself or Andy Adshead. We continue to be one of the lowest cost platforms in the market with an entry point of 0.2%. And as you can see, we offer the full suite of junior products there as well. But from 1st of April, due to the consistent profitability and growth on the AJ Bell platform, we're putting some of those savings back into your clients by reducing the costs from the 1st of April 2024 by introducing another band. So this will be for new business and also will reduce the charges for your existing clients on AJ Bell Investcentre. Due to the service and the cost of the platform, as mentioned during the presentation, we're looking at extending our platform migrations team due to the level of interest from book migrations from other platforms. I had a meeting recently with a firm with 5 platforms in their business, and they weren't happy with 3 of these. So we're looking at different book migrations, and we can tailor the service to work with you and put a project together. If you want more information on this migration team, please do get in contact with a member of the AJ Bell Business Development team. We have a range of technical expertise across the business, and you'll recognise many of these faces from TV, radio, or from the published reports or articles that we issue from time to time. We've also launched our Tech Zone online, where you'll find useful webinars from the technical team alongside some good advisor guides to download. If you want more information on anything you've heard today, please do get in touch with a member of the Scotland and Northern Ireland Business Development team. Thank you for listening. Here to set the scene today on investment markets, dusting off his crystal ball to look at what we can expect in the coming months. Up next is Russ Mould, Investment Director for AJ Bell.
Hello, I'm Ross Mould, AJ Bell's Investment Director, and welcome to this version of my on-the-road presentation for this spring, which I've entitled Ballots, Budgets and Bubbles, which will hopefully give us a few key things to think about and make us look smart in front of clients and customers and help them make smart decisions when push comes to shove this year and beyond. First of all, very important, we need to have a quick check through this disclaimer. And then this to the contents once we've got past that. So ballots, budgets, bubbles, and then hopefully a few useful conclusions to finish. And there is clearly going to be a lot of talk about ballots. We've all read the story in the Financial Times this year that half of the world's population has got a chance to put an X in a box at some stage this year, according to their particular preferences and philosophies. And I must stress now, anything I'm going to say about the UK election afterwards is not in any way an expression of personal political preference or preference on behalf of my employer. I will let you know now, I live in Brighton, my constituency is Brighton Pavilion, and we've got the only Green MP in the country, so I'm a bit of an outlier in that respect, so please don't try and tag anything on me that I'm not trying to say. But you just see from this chart here, we've got elections in India, the UK, the USA, even the Russians are getting a chance, and we've already had big elections in Taiwan and Pakistan and Indonesia this year, so there's an awful lot going on, but I'm going to focus on two ballots in particular, surprise, surprise, the UK and the US of A, both of which do, in theory at least, have the potential to be market moving. So what we've done here is we've looked at all 16 general elections since the FTSE All-Share came in and all 13 prime ministers, and the general rules are, and clearly the past is no guarantee for the future, market doesn't seem to mind if there's a change in government particularly, certainly isn't bothered about the size of majority, and does, it has to be said, generally prefer a Conservative government, although there are always outliers and exceptions to that rule. So the first slide here, this just looks at the data by a change or an incumbent win, and if anything, there's a bit of a honeymoon effect. Maybe not too much as a surprise there, and even over a full term, a new government isn't necessarily seen as a complete bolt from the blue. Now, in terms of size of majority, we can see here on the left-hand side a huge second-term majority for Margaret Thatcher. On one side, a huge second-term majority for Tony Blair. Market lapped at one, didn't like the other at all. Economically, the Thatcher boom was beginning as inflation began to be reined in. On the other side, Tony Blair walks into the bursting of the TMT bubble through the stock, which was a stock market issue, not really an economic issue. No fault of his. It's just the way it was. So again, I can't get too hung up on majorities either way, particularly that's the first chart's actually in nominal terms, the second chart is in real terms, but the same picture very much applies. Big range of majorities, bigger range of performance really doesn't make a big difference. Now, looking at by administration in nominal terms on the left and real terms on the right, again, the importance of the economic backdrop rather than just who's in charge is made very clear here. Okay, on the left-hand side, 4 of the best 5 performing administrations are Conservative. On the right-hand side, in real terms, the worst 3 are all Labour. Now, again, you could argue that Harold Wilson would defend himself if he was still with us, bless him, saying he took over in 74, got in because he inherited a mess. The crack-up Barber boom with Anthony Barber and Ted Heath, and then the OPEC oil price shock of 73. Wilson then came in and was trying to fix that, he would argue, but it certainly took its toll, and then the UK actually ended up calling in the IMF in 76. But again, those kind of market race memories are out there, and there is clearly still some degree of scepticism as to what a Labour government might mean. And again, under Callaghan, the performance was stunning, but actually in real terms, once you whip off the effect of inflation, it wasn't so clever at all. But if I am to make a political point here, just think about this one. I've got American friends, and they talk to me that we have a soft left UK government. I think the bifurcation politically between the centre parties that we have in the UK of the Tories and Labour nowhere near as the bifurcation we potentially have in the US between probably two what we view as harder right parties, the Democrats and the Republicans. And we have actually had a very interventionist Conservative government, not just because of their hand being forced owing to pandemics and lockdowns, but also sugar taxes, windfall taxes on oil and house builders. Intervention in the gambling market is now coming, intervention in tobacco and vapes. It's been a pretty interventionist government, and if only all of that had been in a Labour manifesto under, say, Tony Blair 20 or 30 years ago, there might have been some eyebrows raised, whereas now it seems to be pretty normal. So I think in the centrist pitch that we have, Sunak and Starmer, is there a massive difference? I'm finding it hard to spot when I say that as a historian. On the wings of the parties, there is. So it depends if one of those wings ends up having a bigger influence or not. But in terms of a Conservative government being markedly different from its market views than the Labour one right now, it's pretty hard to see, to be honest with you. No, so markets do need certain things from prime ministers. Prime ministers themselves, and this is again just me as a so they're not having to constantly grease around Parliament. They can actually get something done. They need good health. They need familial support. A failed predecessor always makes you look good, and ministerial experience helps. And Labour won't have any of that on its side. But having said that, the Sunak, Truss, Johnson, Cameron administrations weren't blessed with that either. All of that, by the way, comes from some brilliant podcasts from Sir Anthony Seldon, a cracking historian and now headmaster at Epsom College. What do financial markets want? Clarity on fiscal policy. Clarity on monetary policy. Yes, the Bank of England is independent, but you would like to think that the Chancellor and the Governor were to work together. Whereas, if anything, monetary and fiscal policy have been pulling in different directions in most of the last 15 years. Consistent, but light regulation. Quiet geopolitics, markets will like that. For a Prime Minister, some of our greatest Prime Ministers, according to Sir Anthony, Churchill, Lloyd George, saw us through 2 world wars. Margaret Thatcher dealt with a war and was very popular as a result, and the market lapped it up. Sir Anthony Eden made a terrible mess of Suez in '56 when he was also dogged by ill health. So it isn't by any means a guarantee of success, but certainly markets would like quiet geopolitics, and low and consistent inflation is extremely helpful. The 2% thing, you can argue whether that's a helpful guide or not. I'm probably with Dennis Healey, former Labour Chancellor of the Exchequer, I accept. When he was asked what he thought constituted good government, he said, stable prices, jobs for those that want them, help for those that can't get them. And I frankly think it's pretty hard to argue with that either way. But notice stable prices, not this 2% inflation business to which we're currently subjected. So the conclusions. Markets not necessarily frightened of change. There may even be a honeymoon period. Small majorities, big majorities don't make a difference. If anything, maybe a small one because it means the government can't do quite so much. But it does probably tend on balance prefer a Conservative government. But ultimately what really matters is the economic backdrop. Inflation, interest rates, and they're going to be particularly important as we come out of zero interest rates and maybe come out of quantitative easing. And if we are in a different scenario, we've got used to 40 years of cheap money, cheap energy, cheap labour, cheap goods. If that's really coming to an end, what's worked portfolio-wise for the last 40 years, long duration assets, bonds, tech, biotech, might not work quite so well. If we do get a bit more of an inflationary picture, what worked in the 40 years before that, value, commodities, real stuff, maybe is the thing to watch out there. And in the end, of course, valuation is a huge arbiter of investment return. When Wilson took over in '74, the FTSE All Share was trading on a P of about 3. It's trading on a P of about 12 now, big discount to America. Historically, not expensive relative to its own metrics. So you can argue the UK is unloved and therefore maybe underappreciated and undervalued. We've already seen 2 or 3 big M&A deals in the market this year. Maybe that's a hint that we all need to consider. And again, just look at this. This is the picture. This is what's going to shape a lot of prime ministerial fortunes. Inflation and interest rates. And notice the damage that inflation did in the 70s there and how much benefit we got from a very period of, as investors, from a very lengthy period of disinflation. If that's coming to an end, we may be getting a slightly different picture. And the same applies in the USA, where we also have a major election coming up this time in November. The date's already set. And President Biden's popularity ratings under the cosh because of inflation and the cost of living crisis over there. This is just a look at US elections and the Dow Jones back to 1964, so at the same time period as the FTSE All Share. Notice that the 4th year of a presidential term is normally a pretty good one because, surprise, surprise, they're laying the ground for the next election and they're trying to get a win. The big outlier, George W. Bush, with the collapse and the great financial crisis right at the end of his term there. But overall, 4th term, there's pump priming going on, and surprise, surprise, that's what we're seeing exactly right now with Bidenomics. Overall, Democrats seem to come out better by presidency. This is in nominal terms, I stress. So again, there's possibly that element of inflation in there, but also the hair shirt element of a Republican coming in year 1. Notice how, that thought of, we've got some fiscal rigor coming in here. Nixon twice, Reagan, for example, George W. Bush the first time around. Even if Trump wins, he certainly isn't going to be a classic hair shirt Republican if his previous administration's got anything to do with it. So that might be not a worry that we have to take on board this time. However, we've mentioned pump priming. Let's talk about money. Martin Emmons' very famous book here was about nothing else. And I won't spoil the punchline for you, but the guy on the left there, Fielding Goodney, wasn't quite perhaps as honest as he may have been. And one of the challenges that we've got is ultimately there isn't a lot of government money. At the moment, Bidenomics is priming the pump, running a 6 to 7% US budget deficit when the economy is growing. What on earth's going to happen if there is an unexpected recession and taxation income goes down and welfare payments go up? Look at the US deficit here. It's going to be the third or fourth worst in history in 2024 when things are actually going well. The debt ceiling on the right-hand side has been suspended to January 25 after the election. The question is, can this continue? Can you continue to run 1.7, 1.8 trillion budget deficits ad infinitum? It's hard to do if interest rates stay where they are, because the current US interest bill is $1 trillion a year. That's nearly a fifth of taxation income. And that's when you talk to the Bank of International Settlements and they say budget deficit near 100% plus interest bill that's a fifth of tax income. That's when the economy starts to take a hit. And that's where the US is right now. The UK, thankfully, getting near 100% debt to GDP, but it's only about 15% tax income goes on interest right now. But that is going to focus central banks' minds when it comes to setting rate policy. Yes, inflation is their mandate in the UK, inflation and employment in the US, but trying to keep that government interest bill down will be in the back of their mind. Jay Powell said no, it's not, but he did then say in his last interview that the current fiscal trajectory in the US is unsustainable, so it's certainly exercising some degree of thought in the Mariner S. Eccles building. So there isn't a lot of money, whoever gets in, and that's something that's itself worth bearing in mind. And we also could see what happened with Trussonomics when unfunded promises were shoved in front of people's noses. The market turned its nose up straight away and was violently ill. So as a result of that, one intriguing trend is this. So this is since really the start of the year before the pandemic. Yes. US equity, US bonds, I should say, treasuries, massively outperformed the emerging market bonds as we went into the pandemic because we thought, oh my goodness, we need a haven asset. Where better to go than the US bond market? But look what's happened since then. Since the initial fumbling and the initial wobbling emerging market debt index overall, unchanged. US, trickling lower. So somebody in the bond market, the bond vigilantes, are paying attention to this fiscal profligacy, and they're not totally wild about it. Emerging markets, by contrast, they took their debt crisis lumps in 1998. They've learned their lesson. A lot of them are in a much healthier state, and they were much more proactive in tackling inflation than the Fed was. That's now being rewarded. Keep an eye on this trend because it's not getting a lot of commentary right now. Bubbles, one of my favourite TV series. The Prisoner. Here you have the rover which popped up out of the sea. Anybody trying to escape from the village, they were gobbled up by the rover on the right hand side and whipped back to the village, which is obviously modern day Port Merion. Are we seeing a bubble in the Magnificent Seven? Frankly, it's distinctly possible. Yes, when you've got 7 stocks that are worth 30% of the US equity market, and a US equity market that's 60% of the global market. So those 7 companies, as you can see here on the right hand side, they're nearly worth as much as the world's 4 next biggest stock markets combined. That is pretty tough to argue that it's a particularly healthy situation, and such bifurcated markets don't normally end well. But once a bubble gets going, gosh, can it keep on going? I remember as an equity analyst at UBS Investment Bank in 1999 being part of a team saying this is all nonsense, the Nasdaq's massively overcooked, and it promptly went up by 50% in the next 6 months. At the moment, for all the fact that the Fed has raised interest rates, it's also pumping a lot of money into the banking system after those 3 banking failures last spring. So the market's pretty liquid. This could run and run. But obviously, the bigger the party, the bigger the hangover's going to be. And looking at the previous examples of bifurcated markets, on the left-hand side, we have the 73-74 Nifty 50 bubble in America, 72-73, sorry. Notice that one popped. It took 8 years for the market to get back to where it came from. When the Nasdaq tech bubble popped in 2000, it took it 16 years to get back to where it came from. So yeah, ride it by all means if you want. I don't know when it's going to end, but end it probably will. And when it does end, it's likely to end with a violent bang rather than with a whimper, as J.K. Galbraith said. So how do we spot when that Mag 7 party may end? When people start to think valuing 7 companies the same as 4 of the world's biggest stock, then the world's second, third, fourth, and fifth biggest stock market might be a bit strange. Well, first of all, a vertiginous blow-off rise is one of them. As the final holdouts, the final skeptics capitulate and get sucked in, Tony Dye got fired from PDFM, Stan Druckenmiller in America piled in, bang at the top. Holdout skeptics get fired like Tony Dye. People start saying things like, oh, just buy the big stocks because valuation doesn't matter anymore. Does eventually. You start getting a rash of copycat IPOs, a big slew of secondary offerings as lockups expire and holders try and get out while the going's good. Insider selling starts to pick up, or ultimately people just start saying it's different this time. So watch for all of those things, because that might start to give us a clue as to when it is time to say cheerio to the Mag 7, no matter how wonderful companies they are and how dominant their market positions may be. Now, speaking of it's different this time, that was a phrase coined by Sir John Templeton, a brilliant money manager. Oh, sorry, this mouse is a bit sensitive. There we go. Brilliant money manager. And he said he came up with that glorious phrase that, bull markets start on pessimism, mature on skepticism, or grow on skepticism, mature on optimism, and die on euphoria. So I've done this grid a little bit before. I haven't done it for a while. So in theory, what we should be looking for from a value point of view, where the best opportunities are, is where we're seeing pessimism and skepticism. When we need to be getting a bit nervous is where we're seeing optimism and euphoria, applying the Templeton maxim. So what's flat out of fashion right now? What am I not getting any questions about from customers, clients, or the press? Well, there are your answers. Nobody's interested in China and Hong Kong, or everybody's terrified of commercial real estate. The yen's flat on its back. Nobody's interested in gold, even though it's near an all-time high. Small caps are struggling to make progress, and the UK equities market's still out in the cold, ice cold in Alex. Skepticism, people are kind of poking about, the banks, emerging markets, mining stocks, oil, nobody's interested in, particularly in value investing. What are people excited about? We've seen a big move in interest in corporate debt as interest rates have gone up. And spreads have stayed fairly tight. Industrial stocks have done well. Japanese equities are on a brilliant run because Japan's still pouring on the QQE. Dollar's done well. The US is clearly doing brilliantly equity-wise. And in fact, France of Germany have followed on, and US Treasuries have had a good run. And then clearly the whole world thinks at the moment it's all about artificial intelligence, biotech stocks, the Magnificent Seven in technology. So now what we're looking for is, well, what's going to cause that sentiment to turn? And I guess that's going to be one of the key things we need to discuss with customers and clients going forward. But we certainly know where the lower prices are on offer and where the higher prices are offer. Lower prices at the top, higher prices at the bottom. And the valuation paid is the ultimate arbiter of investment return. So conclusions, yes, it's a big year for general elections and the ballot box. Markets will be keeping an eye on those. I don't think you've got a particularly bifurcated choice in the UK. The wild card, I guess, is if the Reform Party gets a chance to be the tail wagging the dog. Markets overall still have faith in central banks. They still believe in the cooling inflation, soft landing, and pivot to lower interest rates. Although the number of interest rate cuts they're expecting is shrinking from 6 to 4 to 3. The first cuts have been pushed back from March to June, so that is still a potentially very big source of volatility. If we get a diversion from cooling inflation, soft landing, and a pivot to cuts, and we get hotter inflation or a harder landing or later cuts, that's when things could get choppy. And central banks have a lot to juggle, not just inflation and growth, but also those government debts, which are a potentially really big brake on growth if the interest bill is kept too high for too long. Falling bond yields in anticipation of those central bank cuts mean that financial conditions are loose, so they could tighten if the bond vigilantes get going again. And we've got a very, very bifurcated market with tech really leading the way. Industrial is not doing too badly, and healthcare and biotech also being hot. If the Mag 7 start to follow the favour, that could be tricky. We will need something to pick up the slack, but something will pick up the slack. Just as it happened to Walker, the Nasdaq took 13 years to get back to where it came from, but lots of other stocks did well during that period. And if you're looking for potential wild cards, not from the ballot box, oil is one. If we get, heaven forbid, another spike in the oil price, that wouldn't be good news for inflation. Japan is worth watching for the yen because it's right flat on its back, and it's used as a big funding currency because interest rates there are still negative. If the yen starts to rally, then there'll be some nasty hedge fund losses there on the yen short position that they're borrowing against to fund their positions elsewhere. So keep an eye on that. And China, property bubble collapsed. Equity markets obviously flat. I mean, look at the property index there in the top right-hand corner. The property bubble, two bubbles have ended there in fairly quick succession. China, if things get really bad there, it is the world's second biggest economy. The CCTP may have to act. How do they act? What do they do? Or what could the ramifications of that be? At the moment, China's possibly going back to exporting disinflation, which is a helpful thing for the cooling inflation, soft landing, central bank pivot stance. And finally, if we are seeing a major change We had discussed earlier the thought of 40 years of cheap money, cheap goods, cheap labour, cheap energy ending. If that's the case, then we'll be going from we'll be looking to maybe get into real stuff as we did in the 70s. Well, that trade, I thought I was onto something. I first showed you this chart a couple of years ago. I thought, oh, look at that. Commodities starting to outperform, because when this line goes up, commodities are outperforming the S&P 500. When this line goes down, equities are outperforming. Right now, with the Mag 7, the story of cooling, pivoting, soft landing, that's dominating. If that works out, this line will keep on going down, in theory. If it doesn't, and a big change happens, that's when we start to see that line going up, and maybe the move to the real stuff, the commodities, the miners, that are currently also out of favour. So thank you very much for your time. I hope that was thought-provoking. I hope it was helpful, and it was a whistle-stop tour. And I look forward to maybe giving this presentation to some of you in person this spring. Thank you for your time.
Thank you, Russ. Any questions you may have, please put these in the chat box or complete on the feedback form that will automatically load at the end of this webinar. Up next today is a firm favourite from our on-the-road tour, Lisa Webster. This very useful session was rated highly during our in-person events, and many of you will have already seen Lisa present in person or offline. Aiming to keep you up to speed with the latest regulatory changes, including a focus on the planned abolition of the Lifetime Allowance, this is your one-stop shop on the important stuff that you and your clients need to know about. Over to you, Lisa.
So hello and welcome to the technical roundup session. On the agenda today, going to start off with where else but the abolition of the Lifetime Allowance. I think this is pretty much not the only thing, but certainly the biggest thing we've been talking about for the last year now. I'm not going to go through all the ins and outs of the rules in detail, because I did that in the webinar which we put out back in December, and I know we had lots of people who have watched that, so I didn't want to do exactly the same thing again. If anybody hasn't watched it, it is still available on the website, so you can catch up with that. But what I'm really going to focus on today is the bit about the transitional arrangements, because that's where we've been getting the most questions, and then a little bit on death benefits, just because they're really important, or they will be even more important after the 6th of April. I'm then going to touch on the ISA changes that we've got coming in shortly, and I'll finish off with a bit of a roundup in terms of industry news. So let's crack on then. Lifetime allowance. We have a new Finance Act now, Finance Act 2024. This has passed now and got royal assent. When I first drafted these slides, I wasn't sure whether it would have done by the time I presented them, hence the question mark, but it has all gone through Parliament. So there weren't any changes from the finance bill that we saw in November, certainly, well, not in respect of the removal of the Lifetime Allowance. So there's 100 pages of legislation in the Finance Act as it is now, just on the removal of the Lifetime Allowance. And I say there's been no changes to those as that's gone through Parliament. So you would like to think that means we have a little bit of certainty and that we know the rules that we will be working to from the 6th of April. However, it's not quite as clear cut as that, because the Finance Act does have a Henry VIII clause in it. So I know this writing's very small, but basically what this is, it's power to make further provisions in connection with the abolition of the Lifetime Allowance charge. So what this means is that Treasury can make regulations to change the rules. Basically the sections, anything to do with the removal of the Lifetime Allowance charge, any tweaks to legislation that they make doesn't actually have to go through Parliament and be primary legislation. It will be, the Treasury can make changes. And as we can see, sort of clause 4, subclause 4 at the bottom there, that they have that power until 5th of April 2026. So there's 2 years where regulations can still amend these rules. Now, there is a bit in there under subclause 3 that says if it increases anybody's liability to income tax, then that does have to go and be approved in the House of Commons. So it's not quite so straightforward on that. So, the plan isn't, to make changes that can increase people's tax liability in the tax year concerned. But I think it is a bit of an admission that they've maybe that the rules or the legislation as drafted has been done in quite a hurry, and there may be some mistakes and something that isn't working maybe quite as intended in certain areas, and in which case, you know, then they have got powers to change it without it having to be primary legislation. So we'll see. So we are expecting a few further regulations to come out now. The bill has got royal assent and become the Finance Act. I mean, the main principles I don't think are going to change. It will be sort of some like little tweaks around the edges on some of the things which are, say, working as policy intended, potentially, that there could be changes to. So I will give sort of a brief summary of the new world of what testing pension benefits will look like after 6th of April. First thing is that we won't have benefit crystallisation events as we know them now. Instead, we will have relevant benefit crystallisation events, RBCEs, and you will only have any tests or only have any RBCEs when lump sums are tested. So that is the main principle in the new world. So there is no more age 75 tests, and there are no tests when you use pension to provide an income. It is only lump sums that are tested. There's two main limits, which I'll look at in a moment on that. So the actual sort of premise, like the main principle of this, is quite simple. It's just when we get into transitional and some other bits and pieces, it gets a bit more complicated. But the basic principle is quite simple. Only lump sums are tested. Protections are still relevant. So basically, you will have increased allowances for clients that hold protection. There are transitional arrangements, which I shall talk about in a bit more detail. Technically, there is a third limit as well, which is for transfers out to ROPS or CUROPS schemes. That is a separate test. There's a separate overseas transfer allowance for that as well. So let's look at the main limits then. We have two main limits, lump sum allowance and lump sum death benefit allowance, or LSA and LSDBA. For most of your clients, the vast majority of your clients, the only one of these that you're ever going to have to worry about will be the lump sum allowance. So the lump sum allowance is set at £268,275, i.e. the same amount as maximum PCLS that we have at the moment. That number is written in legislation. The actual number, there is absolutely nothing in the Finance Act about that being indexed or being reviewed at any point in the future. It is just a fixed figure. Anytime a client takes a PCLS payment or the tax-free part of a UFPLS payment, they will use up some of their lump sum allowance. If anybody takes trivial commutation winding up lump sums, they have to have some lump sum allowance available in order to do that, but it doesn't actually use it up. That's pretty much sort of on a par with lifetime allowance usage for those lump sums at the moment. Once you've used up your lump sum allowance, it's gone. Any more lump sums you take above that, any excess are going to be subject to income tax on that. So I say that's the main allowance that you will need to look at, and which will be of relevance for your clients. It's your lump sum allowance. We then have the lump sum death benefit allowance, which is set at £1,073,100, i.e. the current level of the lifetime allowance. Again, fixed in legislation, nothing about it changing. When somebody takes a lump sum in their lifetime, as in a PCLS or the tax-free bit of a UFPLS payment, it is also tested against the lump sum and death benefit allowance. Serious ill health lump sums are also tested against this, and lump sum death benefits. Although any benefits that have already been crystallised under the current rules, so crystallised before 6th of April, they're not tested again on the LSDBA. And once you've used it all up, any excess again is subject to income tax. The reason I think that this is not going to be relevant for most of your clients is that in most scenarios, you can take death benefits as income. And the LSDBA only tests lump sum death benefits. So most cases you're going to use up your LSA, taking a PCLS before you get anywhere near your LSDBA. serious ill health lump sums, it will still be relevant in those cases. But in terms of death benefits, I say as long as the beneficiaries can take the death benefits as income, you will never face a test against the LSDBA on that. Which is why for most people it won't be relevant, because you could have, you know, a £10 million pension fund if the client dies before the age of 75. As long as the beneficiaries take it as income, that will never face a test. So really, it's not as important as the lump sum allowance. PCLS then. So at the moment, when somebody takes PCLS, the maximum they can have is 25% of the fund crystallised up to the available lifetime allowance. So we won't have a lifetime allowance after April, and you're not actually crystallising funds when you put them into drawdown, because that's not won't be a crystallisation event after April. So it's phrased slightly differently in the new legislation. So the permitted maximum for PCLS is the lowest of the applicable amount, which is basically a third of the amount that is used to provide an income, be that going into drawdown, being used to buy an annuity, or used for scheme pension. So it's the lower of that applicable amount, the available lump sum allowance, and technically speaking, the available lump sum death benefit allowance. But given the LSDBA is 4 times the lump sum allowance, the LSA, it's very unlikely that the LSDBA is going to be the limiting factor on this. The only circumstances where you're going to use up your LSDBA before you've used up your LSA is going to be if you had somebody that took a serious ill health lump sum, therefore that's not tested against the LSA, it is tested against the LSDBA. So they had a serious ill health lump sum to use up LSDBA, and then after that, to have to be from another arrangement, they then took a PCLS payment. Fairly unlikely circumstances. You're not likely to have clients that, you know, in a position that would do that. So really, when you're thinking about your clients, how much PCLS they can take, you're going to be thinking it's a third of the amount they used to provide an income up to the available lump sum allowance. Okay, so that's fairly straightforward so far, and you know, that's sort of, and I think in the new world for clients that are starting benefits, they've not taken any, not crystallised anything at all, and they'd have their first relevant benefit crystallisation event after the 6th of April, then I think it is quite straightforward, the new rules. However, we now turn to the transitional arrangements, but because of course you will all, I'm sure, have clients that have already taken some benefits and used up some lifetime allowance under the current regime. And so we have to look at the impact that has on their allowances after 6th of April. So we start off with the standard calculation, standard transitional calculation. So this would happen the first time the client has a relevant benefit crystallisation event after 6th of April. So first time they take a lump sum, basically, normally be the first time they take PCLS after the 6th of April. Starting point is if they've used 100% of their lifetime allowance, then they don't have any lump sum allowance or LSDBA. Otherwise, the lump sum allowance, LSA, is reduced by an amount equivalent to 25% of the lifetime allowance used. So it's assuming that when they've taken, when they've crystallised benefits under current rules, they've taken 25% PCLS. That is the basic assumption on this. So the example here is if you've got a client that's used 60% of their lifetime allowance, the equivalent amount that you need to reduce their lump sum allowance by is 25% of the 60% of the lifetime allowance that they've used. And when we talk about lifetime allowance for the purposes of this calculation, we always use the current lifetime allowance. So the equivalent amount works out as £160,965. So you deduct that from the standard lump sum allowance of 268,275. So they have an available lump sum allowance of 107,310. And that's the allowance they would have available on their first relevant benefit crystallisation event after the 6th of April. If we look at LSDBA, again, starting point, 100% used, you don't have any. Otherwise, the reduction will depend on how the lifetime allowance has been used. So if somebody's taken a serious ill health lump sum, then 100% of the lifetime allowance used is deducted from their available LSDBA. If you have somebody who's died and there's been a lump sum death benefit paid out to them, and now you're looking to make another lump sum death benefit payment to a different beneficiary, then you would deduct 100% of the first payment that's gone out. Both of those aren't going to happen very often. For most people, when they die, the lump sum death benefit allowance will just be reduced by 25% of the lifetime allowance used, i.e. the reduction will be the same as it is for the LSA. So in the example as I had before, where someone's used 60% of their lifetime allowance, the equivalent amount is calculated in the same way, 25% of 60% of the lifetime allowance they've used, so 169.65. But you deduct that from the LSDBA this time, so the remaining LSDBA is £912,135. Only matters if you're paying out the death benefits as a lump sum though, otherwise you don't have to worry about this bit. It does produce some quite bizarre results though. So if we have James, for example, who has already used 100% of his lifetime allowance, going forward after 6th of April, he won't have any LSDBA available because he's used it all up already. If we look at John, who's used 99% of his lifetime allowance before the 5th of April, then the LSDBA gets reduced by the equivalent amount, which assuming he's used up his lifetime allowance just by, taking PCLS and going into drawdown or taking a scheme pension, whichever it is, that is reduced by the equivalent amount. So 25% of 99% of the lifetime allowance. So it works out he still has over £800,000 as LSDBA just because he's had that 1% of lifetime allowance used. So it's very odd the way that that works, that cliff edge there. I'm not really sure that the intention is that it's going to work like that. But as I say, I'll reiterate the point that, if you're not paying out death benefits as a lump sum, then it doesn't really matter because it wouldn't be tested anyway. But if you do have some of those old schemes or something where it is only a lump sum death benefits, then, obviously that it could be relevant in those odd cases. So all of that is the standard calculation. That's sort of what happens sort of automatically if you don't do anything else. But as I'm sure a lot of you will be aware, because we have had lots of questions around this, in the legislation, there is provision to apply for a transitional tax-free amount certificate, TTFAC, or I have seen it called TTAX, anything like that, which might give opportunity to take more PCLS. So to apply for one of these certificates, you would apply to a pension scheme, to the scheme administrator, and you'd have to provide complete evidence of lump sums previously taken. So any pension schemes that have been accessed already, how much lump sum has been taken from those schemes. So that could be nil in some cases, particularly if it's a DB scheme and they haven't taken, they've just taken scheme pension, no lump sum from it, then we need a statement, ideally a statement from that scheme to say that's the case. But also if you've done that, but then there's another scheme where you're taking the standard 25% PCLS, you need to know about that as well. So you need to have complete evidence. In terms of what evidence can be accepted, we are awaiting more guidance from HMRC, which is due out. They've said they're going to put a newsletter out the first week in March. So by the time you're watching it, it might be out, might not be, not quite sure. So, we're waiting for more information exactly about what complete evidence actually looks like. And obviously once we have that, we'll let you know what we know, what it comes out with. It is something that we're working on, a project team already. We've put together sort of a draft application form for the certificate, but we'd like to include obviously example sort of evidence that is acceptable, the sort of things that we can accept on it. So if you've got that certificate, then what happens is, instead of applying the standard calculation, as in the last couple of slides, instead the lump sum allowance is just reduced by the amount of the PCLS, or the tax-free bit of a UFPLS, that's actually been taken on that. So looking at these certificates then, sort of thinking about who could benefit from them, the most obvious ones will be people who have taken less than 25% PCLS. But there may be a way that they can take more PCLS now after 6th of April. Over 75s is an interesting one, because at the moment, so we have an age 75 test, and you can still take PCLS after age 75, that's no problem. When we are calculating the amount of PCLS for somebody who's over the age of 75, we ignore the age 75 test when we do that calculation. In the new Finance Act, there is no provision for that. There's nothing in there. So basically, scheme administrators can't just ignore the age 75 test. It is just as straightforward when we do the standard calculation, 25% of the lifetime allowance used. That is the reduction. So over 75s may need to apply for the certificate in order to be able to take all their PCLS if they've not taken it all already. So as an industry, we have gone back to HMRC and asked them if they can change that, because it just seems like, you know, there's a lot of extra work for people having to do that, you know, to need to apply for the certificate. But that's what it says at the moment, so we don't know if that's going to change. And then the last one is an interesting one, because it's for those who took PCLS when the lifetime allowance was lower than it is now. So we had, you know, a couple of years where it was $1 million, $1,030,000, $1,055,000. So potentially these people could get more tax-free cash if they applied for a certificate. Now, the indications from HMRC are that they didn't really intend for these people to be able to get more. Maybe the first group they did, second group maybe, you know, it's just the way it works. But for these people, they didn't really intend for them to get more PCLS. However, the legislation, there's nothing that stops people in these circumstances applying for the certificate. So unless they change anything, then yeah, they will be able to apply still. But before you sort of, you know, rush out and get certificates for everybody, there are a few things that need to be considered. First of all, we do still have this limit that the permitted maximum PCLS is 1/3 of the amount used for income, and that is up to your available lump sum allowance. So there's no point applying for a certificate to get an increased lump sum allowance if they don't actually have a large enough uncrystallised pot in order to be able to take that the extra bit of PCLS from it. So you do need to be careful with that one. The next few slides, I'm going to go through a few case studies, different scenarios about when it might be worth applying for the certificate and when it wouldn't be, sort of based on these three sort of positions. So first of all, looking at somebody who's taken less than 25% PCLS, because these are probably the first people that you think about who might benefit from the certificate. So first of all, I've got somebody who used 80% of their lifetime allowance back in January 2014. At that point in time, the lifetime allowance was $1.5 million. So 80% of the lifetime allowance would have been 1.2 million. They only took 20% PCLS from their DB pot. So that was £240,000 rather than 300,000 if it had been 25%. But they've still got £400,000 uncrystallised in their SIP. If we did the standard calculation for them, their lump sum allowance would be reduced by 25% of the 80% of the lifetime allowance. So we do the sums on that, and it works out that their remaining lump sum allowance is £53,665. If they applied for a certificate as well, because you think, well, they've taken less than 25% PCLS, they only took 20%, the lump sum allowance is reduced by the amount actually taken. So it's reduced by the £240,000 PCLS that they've received. That actually gives them a lower lump sum allowance. they'd only have £28,275. So actually, even though they've taken a lower percentage of PCLS, less than 25%, they would still be worse off with the certificate than under the standard calculation. And that's just because obviously the lifetime allowance was higher at the time that they took it, at the time they crystallised the benefits. So the next example then is again 80% of the lifetime used, but this time it was in January 2016. So the lifetime allowance was 1.25 million. So still higher than it is now, but not quite as high as it was in 2014. Again, they took 20% PCLS, which in this case worked out as £200,000. And they've still got 400,000 uncrystallised in their SIP. Standard calculation will be exactly the same as before. So £53,655 remaining. If in this instance they apply for the certificate, lump sum allowance reduced by the amount taken was 200,000, and so the lump sum allowance available would be £68,275. So they would be £40,000 better off. They could get £40,000 more lump sum allowance. They've got a big enough pot because they've got £400,000 uncrystallised, so they could take 68,275 as PCLS. So in that circumstances, then you would want to apply for the certificate. So really, the point here is it's not straightforward. If you've always taken less than 25%, you're always going to be better off. It will depend on the circumstances, so you just need to work it out to see which one is better. Over 75s then. So here we've got somebody who's turned 75 before 6th of April. They used 40% of their lifetime allowance back in January 2020, when lifetime allowance was 1,055,000. They took just the straightforward 25% PCLS. But when they turned 75, they had a further lifetime allowance test, which used 50% of the lifetime allowance. Still got £500,000 uncrystallised. Standard calculation. Point here is we're not allowed to ignore the age 75 test, so the lump sum allowance would be reduced by 25% of the full 90% of lifetime allowance used. So it works out there that your remaining lump sum allowance is £26,827.50, whereas if you applied for the certificate, then you would have your remaining lump sum allowance would just deduct the amount actually taken, so you'd have lump sum allowance of 162,775, which obviously is considerably higher. And if you've got an uncrystallised SIP of £500,000, that would allow you to take 25% of that as PCLS. So yes, you would want to apply for the certificate. On the flip side over here, what we've got is everything at the top is exactly the same up until the point that they've only got £100,000 uncrystallised. Your standard calculation is going to be the same. Your remaining lump sum allowance under the standard calculation is 26,827. That is higher than the amount of PCLS that you can take. If you've got 100,000 uncrystallised, the maximum PCLS you can take is 25,000 and put 75,000 into drawdown or use it to provide an income by buying an annuity. The point is there's no need to apply for the certificate because you're not going to get any extra PCLS anyway, because you haven't got a big enough uncrystallised pot to benefit from it. So there's really no point in doing it. Okay, I'm going to look at an example now where somebody hasn't taken any PCLS, but also I'm going to look at protection, like the impacts of somebody who has protection and how that impacts the calculations. So we've got somebody here who's used 45% of their lifetime allowance back in 2018 on a DB scheme where they didn't take any PCLS. They've still got 1.8 million in a SIP, which is untouched at the moment, and they hold IP 2014 at £1.5 million. So when we do the standard calculation, the lump sum allowance is reduced by 25% of the amount of lifetime allowance used, which was 45% in this example. But because they have protection of 1.5 million, we substitute that in when we do the calculation. So it's 25% of 45% of 1.5 million. that's the amount that's going to be, that's the appropriate amount that we reduce the lump sum allowance by. But the starting point on the lump sum allowance will be the protected lump sum allowance. So it's the amount of your protected PCLS. So that's £375,000 in this case. So you deduct the appropriate amount from the 375,000. So this gives a remaining lump sum allowance of 206,250 under the standard calculation. Of course, if you applied for a certificate in this circumstances, LSA is reduced by the amount taken. You've taken no PCLS at all, so you can get back effectively your full lump sum allowance, which will be the protected amount of £375,000. Okay, last examples I'm going to look at is where someone's taken the straightforward 25% PCLS. So looking at somebody who's taken this when the lifetime allowance was lower. So somebody used 60% LTA in May 2018. LTA at that point was 1,030,000. Standard 25% taken, which at the time would have been 154,500. Still £500,000 uncrystallised. We do the standard calculation. So the reduction is 25% of 60% of the lifetime allowance. Remaining LSA works out as 107,310. If you applied for the certificate, then you would reduce the lump sum allowance by the amount actually taken, which is the 154,500. Remaining lump sum allowance is 113,775. So that you get an extra just over £6,000 there of lump sum allowance. Now, the uncrystallised SIP there was £500,000, so it's a big enough pot that you could benefit from that. So it would be worth applying for the certificate and getting the extra PCLS, getting the extra lump sum allowance to allow extra PCLS in that example. On the other side here, exactly the same lifetime allowance uses. The only difference is that there's only £100,000 in SIP. So your standard calculation is exactly the same. Your remaining lump sum allowance is 107,000. You've only got £100,000 in the uncrystallised SIP, so there's no point in applying for the certificate because it's, you know, if you haven't got enough uncrystallised funds. Of course, there may be circumstances, you know, where people who still have the ability to make contributions, that if they can get a higher lump sum allowance, may want to build up funds in order to be able to take more PCLS. Potentially that might change the funding decision in some circumstances. So that's just another thing to think about. Okay, before I carry on there, before I finish off with the certificates, there are a few warnings on this one, some quite important points. First one is to apply for a certificate, you have to have it before the first relevant benefit crystallisation event after 6th of April. So if somebody crystallises, has an RBCE after 6th of April under the new rules, and that payment goes through, they can't at a later date apply for a certificate and get it changed, you know, retrospectively or anything like that. It has to be done before the first event. So it is a sort of one chance. So particularly you need to be careful if you've got clients that are taking regular, basically having regular crystallisations. So regular UFPLS payments would be the obvious one. And, you know, if people are doing phased drawdown and actually where they have a crystallisation event each time. Because, you know, if they are regular, if they have them on a monthly basis, you know, they can happen any time in the month. This is normally on the anniversary of whenever it was set up. You know, you might have one of those that is going through on the 8th of April, which is the first working day of the new tax year. If that payment goes through and they have that crystallised, that relevant benefit crystallisation, they have lost the opportunity to apply for the certificate. So I think it's probably quite, if I was an advisor, it would be a high priority for me would be to look and see if I've got any clients that are taking regular payments and just double check whether they are in a position that they could benefit from a certificate. And if you think that they can benefit from a certificate, then you have a conversation with them about whether you pause those regular payments, and wait and get the certificate first, and then you know, and then restart your payments again. It's certainly one to be considered, because if you don't do it, you know, if you just let things carry on, then the opportunity is gone on that. It looks like with the legislation you can only apply for this once. So when you apply to a scheme, the legislation says you can apply to any scheme that you are a member of. The member can apply to the scheme administrator for the certificate with the evidence. Once the scheme administrator receives all the evidence, if they are satisfied that is complete and correct, they have to issue the certificate. You can't decide not to do it unless they have a good reason, because they think there's something wrong with what they've received. If they reject it, say they think, oh, this is missing or this is wrong, then that's it. Basically, you can't then go, oh, well, here's some more evidence, or here's this extra bit, or here's something else. You know, if it's been turned down and it's been rejected, then that's, according to the legislation, that is it. However, it's an interesting one, because the legislation says you can apply to any scheme, so you could potentially then just take all that information and apply to a different scheme for them to give you the certificate, and then take it back to the scheme you actually want to take the payment from. HMRC have said that they expect people to apply to the scheme where they are having their first RBCE, but say the legislation doesn't say that. It says you can apply to any scheme. I don't know whether they'll tweak that with regulations. We'll wait and see on that one. But really the point is just to make sure you've got all the evidence, you know, that it is complete, the declarations are there, you know, when you send it in. So we are working on this at the moment, I say, while still waiting for more guidance from HMRC, you know, to have an application form and to have examples, and, you know, to have a guide that goes with it to help, you know, help with applications. And then the last point I've got on here, again, really, really important. The legislation says if we receive the information, it's all correct and complete, we have to issue the certificate, and then we cannot ignore it. So, and this has been reaffirmed, so this is where guidance and legislation do match up. In the Lifetime Allowance guidance newsletter that's been issued, no opportunity to revert to the standard calculation once a transitional tax-free certificate has been granted. So, you know, if you submit the evidence for your client sends it in, we issue a certificate, and that turns out that there actually would have been better on the standard calculation, we can't go back to it. We have to use the amount on the certificate, which is quite horrible, really. And you know, because as well, once we've had all the evidence, if everything's completed, we're not allowed to not issue the certificate either. If we can see that it puts them in a worse position, that is absolutely horrible under consumer duty, that we can't tell them that, or we can't say, you know, don't apply for it because, you know, it's going to make you worse off, or we can't say we'll just ignore it. But that is what the legislation says, and, you know, at the end of the day, legislation is going to trump consumer duty, even if it puts them in the worst position. So it's horrible. That's something we do hope that they change, you know, because we can't refuse a request and we can't ignore it if it tells you what you don't want to know. So really the message here is, you know, when you do the application, before you do an application, you know, for your client, it is make sure that they are going to be better off than under the standard calculation. The standard calculation is quite simple, so it shouldn't be too difficult to work out, but just make sure of your facts first before you apply. Last little bit on sort of transitional arrangements then. This is just for information purposes, really. So in the legislation, all pension scheme administrators are going to have to send out statements to relevant persons. Relevant persons being people who have had a benefit crystallisation event under the current rules at some point before 6th of April 2024, but they are not actually, they don't have a drawdown pot, it would be in our world. So actually anybody that's in drawdown, they will have an annual statement which tells them how much lifetime allowance they've used. But if you've taken a one-off UFPLS payment, for example, or maybe a few UFPLS payments, but you don't have any, you've only got uncrystallised funds left in the pension, or somebody's taken fat and exhausted a tranche and they've just got uncrystallised funds, or somebody's over 75 with just uncrystallised funds, because those people won't regularly be told how much lifetime allowance they used, and they could have taken the payment years ago and then lost the paperwork or whatever, not know how much lifetime allowance they've used. Basically, all pension schemes have to send the lifetime allowance usage statement to those members by the 5th of April 2025. So really, I'm just telling you this for information, so you know your clients receive these letters from pension schemes that you know why that's coming. Okay, moving on to death benefits then. So I've mentioned this already, I make no apologies for mentioning it again. There's the test against the lump sum death benefit allowance only applies to lump sums. So this means that having the ability to pay to pay death benefits as income is even more important. Particularly obviously for those people who have got large funds, because I say if you've got a £10 million pension pot and the member dies before the age of 75, as long as the beneficiaries take it as income, there is no test at all. If they only had the lump sum option, then it would only be tax free up to the available lump sum death benefit allowance. Anything above that would be taxed. Over 75 is taxed anyway. Still benefits of being able to take it as income rather than as a lump sum, because you can keep it within the tax wrapper and manage withdrawals in that way. But it's really, I say, it's just got even more important to make sure the death benefits are right, and that people have the ability to take it as income. So that's why I'm stressing it now. So beneficiaries then, dependents can be a beneficiary and receive income automatically, whether they're nominated or not. You know, even if you've never done an expression of wish form or anything, then the dependent would always have the ability to pay to a dependent, which is basically spouses of a partner, child under 23, financially dependent or mutually dependent. So you normally think cohabiting couples, you usually meet that requirement. Apart from that, then it's a nominee. So somebody nominated by the member or nominated by the scheme administrator, but the scheme administrator can only make that nomination if there is no dependent and the member hasn't made any nominations. So the sort of scenario where you may have an issue with this is you've got husband and wife, they each nominate each other. First one dies at the age of 74, they're both the same age, around the same age. They both die, the first one dies before 74, leaves it all to the spouse. The spouse is actually independently wealthy, doesn't need the money. And they say, well, actually, can you pass it on to my children, please? Because if my children get it now, they've died at the age of 74, they can have it all tax-free. Whereas, you know, I'm still in good health, I could live for a few more years yet. If they wait till I die and then pass it to the children, chances are it's going to be taxed. Now, in those circumstances, a scheme administrator could exercise their discretion and pay it to the children, but they would only have the ability to pay it as a lump sum. They couldn't make a nomination if the dependent was still alive and the member hadn't nominated the children themselves. And so that would mean if you had a large fund, they passing that on, that would face the test, the lump sum death benefit allowance test on that. So that's why you want to avoid it and make sure you've got beneficiaries on there. And of course, hopefully a lot of you will be familiar with our nomination form, and the way we have it with the nomination section. Actually, as long as you've filled in our form, with a paper form, or if you did it online, then you can, it does automatically nominate all family members, because it has this clause about eligible benefit recipients as per our trust deed and rules, which is basically like the members' grandparents and grandparents' descendants, so it's quite wide ranging. So we would have that ability, but not all providers do it like that. So, you know, you may have it where you need to put the 1% or whatever, or, you know, if you're using other people. So just to be aware of that. Okay, quickly on to ISA changes then. We've got a few changes coming up from 6th of April. These were announced back in the autumn statement. So bit of a relaxation on some of the ISA rules. We're still waiting for the regulations on this, though. As time of recording this, they weren't actually out, hopefully imminently. Basically, after April, though, we know you will be able to subscribe to multiple ISAs in the same tax year of the same type. So if you want to open 5 stocks and shares ISA for one client and they subscribe to 5 of them, they can do. Not quite sure why you'd want to, but you can. You'd still have the overall £20,000 limit. You can still only apply for and pay into, I should say, subscribe to one lifetime ISA though, and for children, for junior ISAs, it's still only one of each type. That hasn't changed, but for the other ISAs it has, or it will be. Partial transfers will be allowed with current year subscriptions. You don't need to reapply if it's lapsed. So if you've subscribed one year, don't subscribe in the next year. At the moment you have to reapply again. That requirement will be dropped. And then cash ISAs are going to be for over 18s only. Yeah, so that we have a little bit of a loophole, if you like, at the moment, where you have 16 and 17-year-olds can have a junior ISA and a cash ISA, and have the £20,000 going into a cash ISA, and you can have the 9,000 going into the junior ISA. We're going to be losing that because it'll be 18 for a cash ISA as well. Other thing that was announced in the autumn statement on ISAs was around fractional shares. Some of you may have seen there was these headlines last year. I've got one from June there. Shock tax shares and shares row. So this is all about whether fractional shares can be held in ISAs or not. It's not anything we've ever allowed because we didn't think it was within the rules, and HMRC have now confirmed that it's not within the rules. Some other providers have allowed it. We'll wait and see what happens with that. But the good news is that they are planning to change it, so this should be allowed in the future, which would be great. You know, we would like to allow them. It's not going to happen from April though. It's a bit further down the line, that one, the changes for that. But you know, it's in the pipeline. It's coming. Okay, just to finish off with a bit of industry news then. Starting off with the FCA. So a big piece of work going on at the moment, retirement income advice review. I'm not going to talk more about that because you've got Mel talking about that one. So moving swiftly on, advice guidance boundary review. By the time you're watching this, that should be closed. But again, that's another piece of work that's quite a big area of focus for the FCA. It may have more impact for us possibly than for you. It's early days yet. It's a discussion paper, so we'll expect a consultation to follow on that. Can't not talk about consumer duty, can we? So consumer duty, obviously ongoing reviews going on now. We've got the closed books coming online in July, into July. And so then everybody will be in consumer duty. But importantly, the FCA had a paper out last week on the implementation about good practice and areas for improvement. It's about 6 or 7 areas that they looked at on there, things that they liked, things that they didn't like that they were seeing. They saw a lot of good behaviour in terms of people focusing on customer outcomes. There were some things that they didn't like still. There were some firms that are asking vulnerable customers to identify themselves as vulnerable and provide evidence. Still not enough staff training from some firms. Still some firms treating it as a compliance and risks job to do consumer duty, rather than it being, you know, board level and then throughout the business, and that it's everybody's job to do it. They have seen some good work on customer journeys. There's quite a lot of information in there, so really just want to highlight to you and go and have a look at it. You know, there's a couple of pages on there, and make sure that you're falling on the right side of it, because one of the other things I will just mention is that they didn't like is that they thought that there were some firms that were waiting for the FCA to intervene before they took action. You don't want to be doing that, so yeah, do go and have a look and make sure you're on the right side of things. Last couple of things, small pots is moving on. Small pots has been talked about for years. We do now have a delivery group who are trying to work on how the best way to implement the government's preferred approach which was confirmed in the consultation feedback we had in November. So they're looking at how we have a clearinghouse, the role and function of the proposed clearinghouse. So small pots will go to a clearinghouse, and then they will send it out to one of a handful, 3, 4, 5 maybe default consolidators, and how that will all work. So that's all in progress. One thing that we are outstanding at the moment is the DWP general levy. This was the consultation. This is long overdue, the response of this, the rates of the general levy on pension schemes. We're going to see an increase from April. There were 3 different proposals they put forward. I think for SIPs, it will generally be at a level where most of it will be absorbed by providers. The big news on this one was regarding SAS, for those of you involved in the SAS market, because the preferred option was including a £10,000 premium on SAS, which would apply from 2026. So yeah, we're still waiting, so overdue on this one. Watch this space. Is all from me. I do hope that's been useful, and thank you very much for your time.
Thank you, Lisa. If there's anything at all you'd like to ask Lisa about, do let us know and we'll get back to you with the answers very soon. Time for a short break. We'll be back in 5 minutes. There's enough time to top up the coffee, and we'll see you back here shortly. Up next, our guest speaker, Mel Holman, Managing Director from Compliance and Training Solutions, otherwise known as CAT, will provide an overview of the current status and information available on the Retirement Income Review. Looking at the true meaning of fair value and how this links into your consumer duty requirements, she'll dive straight into some of the FCA concerns and ask what else should they be addressing. Linking all this together, she'll help decipher what value really looks like to both you and your clients. Ladies and gentlemen, Mel Holman.
Welcome to this webinar. I'm delighted that AJ Bell invited us, Compliance and Training Solutions, to come along and talk to you today about Retirement Income Review. So a bit about us, Compliance and Training Solutions, or CATS as we're otherwise known. We've been going since 2005. We look after financial planners throughout the UK, and we love what we do. So today, looking at Retirement Income Review, gosh, we've gone through a lot, haven't we, in the last 10 years? I mean, we had RDR 2012, we've had MiFID II, we've had GDPR, and then of course we've got the Consumer Duty, which we just spent so much time over, didn't we? And of course, the FCA have said that the Consumer Duty is not a one-time fix. It is now, it should be embedded into everything that we do. And that would include the Retirement Income Review, which really we feel now you need to be focusing your attentions to, because it's been bubbling along for a long time. So the point of the session today is for you to maybe, there's a danger that it's going to ask more questions for you than answer the questions that you may have. But to give you an overview of the kind of things that you need to be considering and how that gels in with the Consumer Duty. So, learning points. As I say, we're going to look at the Retirement Income Review and see how that blends in with the Consumer Duty. Why does it matter? Look at fair value. Does our retirement process really reflect fair value? How can you truly define value, particularly for decumulation clients? And what is a centralised retirement proposition, and how does that all fit in with value? So there are some of the things that we'll be covering off today. But let's just set the scene, shall we? So, gosh, the Retirement Outcomes Review started way back in 2016. We had, of course, had Pension Freedoms Act 2015, and the FCA decided, look, actually, we've got all this flexibility now about how you can take your pension pot. We need to look at what that means for the end consumer. And to be fair to them, you know, that they did their research, and their research found that there was a steady decline of people being members of DB or final salary schemes, and we've seen the aftermath of that, haven't we, with the mini review that the FCA has done in DB transfer advice. But they also found that because of the freedom that consumers have got in taking their income in retirement, it of course brings around a lot more complexity, and there's a lot more decisions. And if they don't understand the impact of those decisions, it then impacts the rest of their retirement life. So the FCA then, you know, introduced a consultation paper with some recommendations to change. And that then introduced the policy statement 19.1. And within that policy statement, that really introduced the welcome packs that product providers have to now publish and issue when somebody's looking to take coming out to retirement age. And those wake up packs are looking to impart and educate the client a lot more about annuities, what an annuity is, and enhanced annuities, and encourage that shopping around. And the welcome packs also make it clearer for the consumer of what they're paying, you know, and where the money is at the moment. So a lot of work has been bubbling away. But then we had the Consumer Investment Strategy in 2021. And the Consumer Investment Strategy, the FCA started moving their attention away from product providers and over to the advising community. And the Consumer Investment Strategy in 21 looked to, you know, fair play to the FCA. Do you know what I mean? They set out in this strategy document a 3-year plan as to, look, this is what we're going to focus our attentions on for the next 3 years, and this is how we're going to monitor our progress. And so they're going to be basically accountable for for the strategies that they're going to implement and what they're trying to address. And within that consumer investment strategy, it reinforced the fact that this retirement income strategy review is not going away, and they're going to be focusing their attentions on that. So what does that mean for us so far? Well, we had review number 1, didn't we? And that was back in 2020. So the FCA asked a number of challenging questions. So to start with, the examples of those questions was, give me a list of clients that have taken some kind of retirement income. Who gave that advice? When was the date? Were initial and ongoing fees being charged? They asked the age of the client. They asked for the withdrawal type, and then whether it was just tax-free cash and income, what was the strategy? And it included, what firms had to submit up was not just clients that were taking an income from a pension, but also other assets such as, GIAs, ISAs, that kind of thing. So they were looking at the income withdrawal strategy. But of course, COVID came along and this review got scrapped. There was a number of firms that did send up files. The FCA, following this information, they requested a number of client files. The firms sent it all up and waited with bated breath throughout 2020. And until such point, the FCA kept delaying the review, and then said, look, we'll just put it on hold indefinitely. And then people wondered, what's happening? Where's this going? So the FCA then issued review number 2, and that was in June last year. Now, this was a voluntary questionnaire, supposedly. That was a whopping 61 pages long. Now, what I think is interesting about this questionnaire is, one, it did include equity release. So it wasn't just, again, pensions and your other assets that you're using to take an income from, but it started venturing into equity release and identifying, I suppose, that there are a number of clients out there that don't have pension pots, large pension pots. They've just got their state pension maybe, and they need to use some other asset to help them with their retirement income. So this questionnaire really got quite, well, as I say, it's quite chunky, but some of the questions were really quite involved. I mean, basically it looked at, the firm oversight, who the firm's target market was, the types of services being offered. They looked at charging structures. They asked questions, for example, do you have a different charging structure for an accumulation client compared to a decumulation client? Never seen that question before. That gives you an idea of where the FCA's thought process is perhaps going. They asked whether a firm used a platform. They looked at in different investment selections, different investment strategies. They did ask about a withdrawal strategy. Again, never seen that question asked. They asked whether we do any particular retirement income fact find, specific fact find for retirement, like decumulation. Looked at what risk profiling tools firms use, research, cash flow modelling. And on top of that, they looked at the staff competency and remuneration. They did ask if a firm has a centralised retirement proposition. They also asked about how often does a firm do any rebalancing at all. It asked about whether you use discretionary investment managers. I mean, it really was quite involved. And as I say, it gave an idea of where this path was going by the FCA. And then this led on to review number 3. So a number of firms who completed that voluntary questionnaire were then contacted again, and they had to submit more information. Now, it turns out I've seen 2 different FCA communications asking for follow-up information, and they've been different each time, pretty much. It looks like they are making it quite specific to the firm. But some ideas of what the FCA is asking for is around a copy of the organisational chart for the firm. That's always a standard. That always happens. Copy of their new business register. You'll be surprised how many firms out there do not have a new business register. So just, the FCA do expect you to be able to produce, whether that's an Excel spreadsheet or from your back office system, how much business and what advice are you writing in any given time and by whom. It asks for a documented process for conducting annual reviews. It's asked for a vulnerable client policy, the Consumer Duty implementation plan that all firms had to have in place by the end of October 2022. It's asked for a risk register. It's asked for statements of responsibility for each of the senior managers, the directors, and copies of introducer agreements. Now, if there's one thing or two things that you take away from today, if nothing else, is one, make sure that you have a documented process for your annual reviews. Whenever we do annual audits, for example, on firms, we always ask firms, what is the process? And every firm can give me an idea what the process actually is, including about charges, disclosure, and things like that. But this is asking for that process to be properly written down. So if you haven't got it properly written down, then go away and do that. The other thing is asking for a risk register. Now, there's nowhere in the FCA handbook where you see that all firms have to have a risk register. But what it does say under CISC is that all firms need to be able to identify what risks the firm faces and what they're doing to manage those risks. So again, if you don't have a particular risk register, start thinking about how do you evidence that the firm is looking at risks. Is it at minutes of management meetings? Is it minutes of board meetings, for example? You can have an Excel spreadsheet that says, this is the probability and then the impact of this risk occurring. Some people will have traffic light systems, for example, for their risk register. Point being, it doesn't matter how you address this, but if you got contacted by the FCA asking for a copy of your risk register, what you got to submit? Because you want to be able to be in a position whenever the FCA asks for information that you can get it off your desk quick. It makes you look efficient, makes you look as if you know what you're doing, and the chances of any deeper scrutiny starts to reduce. So that's where we are at the moment. This firms been contacted, they've sent up their information. The FCA on their website has said they were looking to send out publish feedback as to retirement income review at the end of last year. That's obviously been delayed, and they're now saying Q1 2024. So I checked this morning, and nothing as yet from the FCA in terms of feedback. So watch this space. So I've got nothing to give you concrete as to where the FCA is going with this and their findings, but let's explore where the direction, given the questions they've asked us, let's explore where they might be going and start thinking about, if you got asked these particular questions, how are you going to answer those? So if you remember at the beginning, we said we're going to look at how the retirement income review, it started off back in 2016, plotting its way to us now in financial planning firms. In 2024, how does this fit in with Consumer Duty? Now, of course, guys, you'll know this grid off by heart, I'm sure, about the Consumer Duty. So we've got the principle, the high-level principle that says that we must act to deliver good outcomes for retail clients. So obviously the Consumer Duty does not apply to professional clients or eligible counterparties, but in the main, all financial planning firms are dealing with retail clients, of course. And then, of course, we've got the cross-cutting rules, acting in good faith, avoiding foreseeable harm, and supporting their objectives. That's really relevant, isn't it? To somebody going into retirement, and that ongoing need to make sure with that relationship with the client of avoiding foreseeable harm. You're not expected to have a crystal ball here, by the way, but you are expected to be proactive if you believe or identify that as an area that a consumer could have some detriment. And it's really also pinning down their objectives. What does retirement look like to them? What does good look like? And then, of course, we've got the 4 outcomes of products and services, price and value, consumer understanding, consumer support. Now, just to labour the point, I suppose, let's remember that the Consumer Duty packs a bigger punch than Treated Customers Fairly review, that initiative. The Consumer Duty is backed up by rules and guidance under PRIN 2. The FCA can come in and say specifically you are in breach of this particular rule. This is why it's integral to the handbook, and this is why it's just not going away, and it needs to be just enshrined in everything we do. On top of that, the Consumer Duty makes continuous reference to vulnerable clients within the rules and guidance. Now, of course, prior to PRIN 2, the Consumer Duty, they had the guidance document, didn't they, on how we should be identifying and treating our vulnerable clients. But now they're actually using reference to vulnerable clients and making sure that firms identify vulnerable clients and they can walk the walk. They can show how they're adapting the advice journey that the client's receiving, depending on any vulnerabilities that they have. And that is backed up in the rules, as I say. And then on top of that, you've got to then factor in any behavioural biases. And again, that the rules make reference to behavioural bias. And that's not just you as the financial planner, but also your client. If they're coming in with a preconceived idea about which particular route to go, remember, you are not an order taker. Your obligation is to make sure that you're given a recommendation that is suitable and is meeting their financial objectives. And there will be times where you will have to say things to clients that they do not want to hear. But this is where you have to educate them and get over this behavioural bias. And we also need to challenge ourselves, don't we? Do we have a particular bias that we could be imposing onto our client as well? So, gosh, this Consumer Duty is just massive, isn't it? And we're just still feeling our way through and looking and seeing what good looks like. But let's move this on into that retirement journey. So here's retirement life cycle. So I've broadly put these ages in place. Don't read too much into this, but we've got from 20 to 55, or it could be 18 to 55. So you're accumulating those funds, aren't you? You're an accumulator client. We've got workplace pensions, most probably, and you're gradually putting in that income, and you don't really know what retirement looks like, especially when you're so young, and you've got other priorities going at that time. But then age 55, the current age that you can take a pension benefit, you're starting to think about retirement. Then more likely between 60, 67, you may be thinking that you are retiring, and you've got those golden years, haven't you, where you that's where you want to go travelling, or you're doing something to the house, or you get your motorhome, and hopefully your health allows you to do this. And then of course you moves into 80s plus, where you may be starting to slow down and possibly thinking about care costs. So the journey, when you look at the retirement part, it's still quite a few chunky years, isn't it? That we need to, you're not accumulating those funds, you're not earning income, so you've got funds there that has to last you throughout that whole cycle. So of course, that then leads to the issue of sustainability. Now, the FCA published a guidance paper FG 21.3 back in 2021, and you could be mistaken to think that it only applies to firms that give DB transfer advice, because it was set out to back up the latest changes in DB transfer advice, the policy statement. But FG 21.3 has so much reference to the normal COBS rules that actually it doesn't matter if you give DB transfer advice or not. It is definitely a paper that you need to be reading and getting familiar with, because in this paper, amongst other things, it starts to say that firms have to and should be ascertaining the breakdown of a client's expenditure. So they look at essential spending. That is basically your bills, your council tax. Will you still be paying rent? Will there be, more and more clients are getting mortgages, up to 70 odd. How are they going to be paying that off? And then there is your discretionary spending. So that's your lifestyle expenditure. So, holidays, how many holidays do you want to go on each year, eating out, the gym membership, the golf membership, etc. And then you've got your luxury items. And that could include things like gifting to grandchildren, helping out with, education costs, etc. Breaking that down. So the FCA put it in this paper, FG21-3, for DB transfer advice, but it is this kind of split of looking at what spending a client faces in retirement is lending itself to this retirement income review. So unlike an accumulator client where they, when you're doing your fact finding under COBS 9 for suitability, of course, you need to ascertain about affordability, and you may not go into so much detail as this. You may be getting on the fact find a lump sum of what expenditure looks like. When you're looking at retirement and retirement income strategies, you really need to break this down and get to the nitty-gritty of it all. Because this then lends itself to leading on to the attitude to risk and capacity for loss. Now, just a reminder, I'm sure you don't need it, but I'm going to say it anyway. Attitude to risk is emotional, isn't it? It is how would the client feel if their portfolio dropped by 20%. Capacity for loss is can they actually afford for that fund to drop 20%. One is actual, one is emotional. Capacity for loss is not how would the client feel if their fund dropped by 10 or 20%. It's about the client's ability to absorb the falls in the value of their investment. And as we go into retirement, the shift in risk moves from I've got a long time until I need to take the funds, because we're building it all up, and to the state of mind of, oh my God, I'm going to retire and I'm not going to earn anything. And how am I going to make sure that I don't run out of money in retirement? Looking at, revisiting that journey and those golden years, am I going to be able to afford to do all the things that I want to and to have a good retirement? And if not, it's for you then to be having those discussions about what retirement looks like, what the compromises are, maybe. But it is a complete mind shift. I've got a friend who's coming up to retirement. He's been telling me for the last 2 years he'll be retiring, and yet he just can't bring himself to press the button and actually retire because he's got that fear behind him that he's not going to be working again, and therefore he's going to run out of money. So for you as financial planners is helping the client with that journey, isn't it, emotionally as well as the financial planning side of things as well. And that's where you help and bring in about sustainability of their fund. Also, of course, when looking at risk in the retirement, you need to be looking at and having discussions with the client about longevity, as well as investment risk, mortality drag, inflation, and changes in regulation and tax. Now, these are conversations that you do have with your client, absolutely, but sometimes it's not very well documented. And as with anything, with the consumer duty as well, especially, it's all about how we are documenting those conversations. And with the use of AI now, for example, and technology, we should be able to capture those soft facts and those discussions much more easily than before. So other factors to consider for sustainability. Client objectives. Now, we all love a cow. FOS loves a cow. The regulator loves a cow. Cow is client-owned words. And in order to help demonstrate not only the COB's 9 rules around suitability, but the cross-cutting rule of making sure our recommendation is meeting the client's financial objectives, client-owned words is just so powerful. And you don't need to minute every conversation that you have with a client, but just having a snapshot of phrases that they bring, that they say, then just brings to life your conversations and the direction of travel when you're talking about their retirement journey. And then, of course, their objectives then has an impact about the sustainability and on the fund value. You also need to be looking at, as I said, the impact of client behaviour. There's been many times actually where I've seen situations where the client has been emphatic. You know, I'm going to do DB transfer. I'm not going to take the funds for another 5 years. I'm going to carry on working. And then I look at the file a year later and the chap's taken his 25% tax-free cash. He's now retired, and that's completely different to the objectives that he first gave the financial planner at outset. And that happens, doesn't it? You know, that is client behaviour. Circumstances change. There may have been an impact in their health. For example, they may have had a scared, health scare or something. But you can only advise the client at that point in time. And you can only go by what they tell you their objectives are in that point in time, which is why it's so important that you get this documented. It's also important that you have a process when somebody's starting that retirement journey of having regular reviews with that client. You then need to be, of course, considering pound cost of averaging and sequence risk. So pound cost of averaging obviously is the opposite of pound cost averaging. So of course, if you're taking an income and the market's going down, your money is going to have to work harder, isn't it? And basically your funds going to fall faster. Sequence risk, is the fluctuations, and if we have a downturn in the markets, will you have enough time to build up the funds that you need to again? To maintain that income that you need. So again, there are tools out there to help evidence that you're having these conversations with clients, Monte Carlo theories, scenarios, for example. But again, sustainability in the retirement income journey for the client is just so key, which is why you may need to be thinking, if you haven't got already, some kind of retirement income fact find, or again, the process. How do you capture all this? That then leads on to, the next step, the type of strategy you're going to go down. So, centralised retirement proposition. As we know, under PROD and Consumer Duty, we need to identify who our target market is and look at the process, the investment strategy process that we're going to have in place for that particular target market, and the journey that client is going through their life. So we've got the accumulation, and it's our centralised investment propositions, and then of course when they're actually taking monies from those assets, whether it's a pension, GIA, offshore bonds, ISAs, they're spending the money to help them manage retirement. Firms need to start considering their centralised retirement proposition. Don't forget, under PROD, somebody has to be responsible for PROD, and it has to be on the statement of responsibility. So a quick tip, just make sure that, revisit your statement of responsibilities and find out who is dedicated and wholly responsible for having PROD documented and followed and reviewed. So back in 2020, Rory Percival, when he was working for the FCA, was going around and educating firms and advocating that we should have a centralised retirement proposition in place. And the centralised retirement proposition has a different emphasis to our CIP. It needs to be one that is a repeatable process, as much like our CIPs, but it's also one where it needs to be flexible. You know, we need to be able to adapt that centralised retirement process to accommodate our vulnerable client, for example, or somebody who, if we just said everybody's going to have an annuity, that may not be appropriate for the client. Again, revisiting it back to the consumer duty, meeting the client's objectives. If you have a steadfast way of doing things, you're in danger of not being able of breaching that cross-cutting rule, basically. So again, you won't see anything in the handbook that says you have to have a centralised retirement proposition, but it certainly seems to be the way that is going. And given the FCA questionnaires that they had in the past few years and last year, they're starting to ask specifically if a firm's got a centralised retirement proposition. That's kind of a big hint, isn't it? So if we haven't got a CRP in place, we need to be thinking, well, why? Why haven't we got a CRP in place? Do we have exactly the same strategy for our decumulation clients as our accumulation clients? And if we do, and the FCA challenge us on this, how are we going to answer it? How are we going to say with confidence, this is okay because? How are we addressing the issue of sustainability, longevity risk, etc., etc.? So we then go into retirement strategies. Now it's interesting, isn't it? Since pension freedoms, drawdown seems to be the default option these days, whereas it used to be annuities. Definitely drawdown seems to be, people want flexibility, and sometimes it's for inheritance purposes, etc. Just a reminder that taking tax-free cash only is a crystallisation event. It is drawdown. The amount of times I see firms that are not documenting when somebody just takes their tax-free cash, they see it's just a withdrawal from a pot. It is a withdrawal from a pot, but it's also a crystallisation event and full advice has to be given. And the FCA, in their latest discussion paper, DP 23.5, the advice guidance boundary, they say that they've excluded drawdown from the proposals of simplified advice because the nature of drawdown is complex. For drawdown clients, they have to be engaged in the process. They have to have regular reviews to make sure that we're looking at the sustainability of the fund, adapt for any changes, etc. We need to be sense checking their capacity for loss, their tolerance for fluctuations. We need to be and should be introducing as part of the process. As somebody gets older, they start to get more disengaged. They start not having their annual reviews because they can't be bothered, or they find it complex. Their attention span may be dwindling. So do we have a process to make sure that we're getting and encouraging clients to have lasting powers of attorney in place? Because those LPAs would then be stepping in for those drawdown reviews, for example. Have you started to think about what happens as the client gets older? Starting to see it more and more, especially when the client gets dementia, they're more frail. How firms are finding themselves in a difficult situation now because they haven't got an LPA in place, and the contracts, of course, in drawdown, you're still incurring charges for the investment process, the platforms, and for advisor charges. How is that all coming into the mix? More on that in a minute. So, of course, you can also be looking at annuities, and that includes enhanced annuities. I know that at the moment annuity rates have been really good, and feedback has been from some providers that there's quite delays in waiting times in getting the annuities processed. However, just because there may be delays in processing applications does not mean to say that you do not recommend an annuity. And indeed, the FCA want clients to have that essential spending covered by guaranteed income. If we haven't got that in place, if we're not really drilling down what their essential spending is and how they are paying and covering that essential spending, you need to update your centralised retirement proposition to accommodate this and make sure that everybody's singing from the same hymn sheet in the firm and that we're getting this covered off. Of course, you do have third-way products. So third-way products being where the client can get a guaranteed growth on their fund, or they're taking an income and there's still an underlying value of the fund, tend to be some higher charges, but they have their place. You know, some people like that kind of like hybrid approach of a drawdown and annuity. And if we are discounting third-way products from our prod, from our retirement strategy, why is that? Because sometimes they may be appropriate for a particular client. Remember, we've got to meet the cross-cutting rule of meeting the client's objectives. Of course, we've got other assets that we should be using, and we could throw that all into the mix, can't we? About, you know, where's the most tax-efficient way of taking an income from assets. You may be looking at natural income taken from a portfolio. Again, you've got to be looking at a sustainable withdrawal rate. You know, the 4% sustainable withdrawal rate is kind of like is out there, isn't it? It's kind of been enshrined in time. Is it right? You know, there's arguments, pros and cons, isn't there, for that? Really, if we're going to go down that route, what we need to be doing is just documenting what we think a sustainable withdrawal rate is and why. What's the logic behind it? And then, so as long as you can explain how you come to the conclusion you have, then that's fine. You obviously need to be looking at emergency funds. 3-pot strategies out there. There's lots of firms use the 3-pot strategy where we're looking and keeping safe, like cash, for example, for the first 2, 3, 4 years. Then we're going to safer assets to then start taking an income, and then you've got your equities for growth, and they work really well. And then there's a school of thought of the Nick Murray strategy, where I've got some firms where they do keep aside 2 to 3 years of expenditure in cash, and then everything is invested 100% into equities. Again, that's fine, as long as the firm has explained and had those discussions around longevity risk, you know, capacity for loss, etc., etc. They're all retirement strategies that you can consider. Remember, you've got to know your target client. So that really needs to be defined within your prod. So then we're going to cash flow modelling. Now, cash flow modelling is not mandatory. Nowhere will you see in the handbook that it has to be done. But it's getting to the point where it's pretty much impossible to do without some level of cash flow modelling. Now, I know that, you know, cash flow modelling is, you know, level. It doesn't take into account changes within, you know, from year to year. It's using assumptions, so it's wrong as soon as you publish it and talk about it to the client. But they are really powerful, aren't they? In visual. Now, thinking about, again, consumer duty and about how we communicate with our client, how we get them engaged in the process. Don't forget, we've got to check their client understanding. You know, and doing something cash flow modelling where it is visual helps with that client journey. And it does look and help demonstrate capacity for loss and sustainability. But if we do cash flow modelling, how often do you actually look and review your assumptions? Are we making sure that the whole team is using the assumptions that you have set out and agreed and believe that we should be using? Or do we have a rogue advisor who's going off and changing the inflation assumptions or investment assumptions that are being used, for example? Have we got our assumptions documented and the conclusion as to why we're using this particular assumption? Again, as I say, is it being communicated and agreed with the client? And do you stress test the cash flow model? And if so, what stress tests do you do as a firm? And how is that communicated with the client? Some firms use Voyant face-to-face with the client, for example, doing it there and then at the same time, which is awesome. It gets them engaged. But don't forget, all those changes that you make, you need to somehow capture this. So whether that's recorded and you keep that recording, you save the various stress tests and then put them into a financial plan. That's also, you've got a bit of an audit trail there. Don't forget also the graphs and cash flow modelling, that you actually do define what the bars are showing. Now, the client may be picking up this financial plan a few weeks down the line after a discussion with you and totally forget about what we talked about. So again, just be really looking about our communications with the client. Is it Janet and John stuff? It doesn't matter if somebody is uber wealthy and uber intelligent. A lot of people are asset rich, time poor, aren't they? So we need to be making sure that our communications with the client are easy to understand. And as Melissa Kidd from Motum, she's an expert in communications with clients, and she says that basically we're a nation of speed readers. So we're just scanning what's being presented to us. So we need to be mindful of that. So how does this all fit in with value? Well, of course, we need to be looking at our charges. So every firm should be having a value statement in place. We should have done our research as part of our consumer duty plan to be looking at our platforms. What value are they giving us? What do they charge us? Looking at the model portfolios, what are the charges, individual charges? If we use a discretionary investment manager, a DIM, what are they charging? And then us, what are our charges? Is it providing value? And then collectively, is it all the charges that the client's paying? Is it providing value? Now, the FCA have started contacting firms, and totally separate for this, looking at consumer duty and asking about their value statements. Don't forget that you should have a value statements for every fund manager, every platform you use. If you've got a client that has legacy funds, products that they're using, you need to be having a value statement and looking at that value of their portfolio at the time of the annual review. Just because they're not in the model portfolio, for example, that doesn't matter. Don't forget, by the way, that if you've built your own model portfolios, you are considered to be a manufacturer of that model portfolio, and therefore you need to be considering what a manufacturer's obligations are for building that portfolio. So we should be having, the other thing is, don't forget also, considering what I said earlier about avoiding foreseeable harm. If you are told a fund manager, for example, has published that a particular fund is not providing value, you need to do something about it straight away. Do not be waiting for the client's annual review meeting to do a fund switch, for example. You need to be taking action straight away, looking at what fund we're going to replace it with, if we are, do their value assessment for the whole piece for your clients, and then to communicate that out to clients. The value assessments for firms is not a do it once a year exercise and be done with it. You need to be thinking, it's quite a fluid document. You need to be thinking about it all the time. And we should also then start thinking about not just our value, our charges, but do we need to be looking at the client journey and what value we're giving through that journey? So at what point are we not providing value? We've got somebody that's in drawdown, charging a percentage of that pot, and they're taking an income. Of course, that's gradually going down, isn't it? Down and down over time. And you could be getting to a point where actually the pot is getting to such a value that actually you don't think that you're giving value. Your charges are too high for that pot. But that could be at a time when the clients are they're most vulnerable. And is it fair that you just write them off and disengage from them at that point when you've taken a fee all the way along? So at what point is that annuity the default option? And of course, relate it back to client objectives. There could be other reasons why we're in drawdown, inheritance purposes, for example, but that we need to revisit those options or objectives all the time at each annual review. Is this still relevant? Or actually, Mr. Client, are you finding that these annual reviews are just a bit frustrating for you? You prefer not to do them, and therefore we need to be getting an annuity. Are there different services, different strategies in retirement, as they get older, that we should be considering. As I say, what happens when the client gets older and loses interest in the annual reviews. And on top of this is the vulnerable clients at all times. There's an argument that charging a flat fee each year can better show value, because it's a set fee. And it's not dependent on the fund value going up and down. It is what it is, and this is the process, and this is what you get for your set fee. Not all firms are doing that. Some firms have done it and then moved away from it for whatever reason. But these are, I think, some of the types of questions that the FCA are going to start challenging firms. And if we're going to have a percentage fee, that's okay. But how are we going to explain how our service is different for our decumulation clients, and how do we manage that conflict, I suppose? Management information is your friend here. Management information can help demonstrate the value that you're providing along this client journey. Complaints, errors logs, tracking your client review meetings, looking at the client feedback, obviously. This we take for granted and see it as like a standard KPI, but actually what you need to be doing in demonstrating and documenting is, what is it actually telling us? Are we starting to get feedback from clients that they don't feel they're getting value, they're shopping around more, for example? How do we compare to our peers? What else? We need to be, obviously, with as I've alluded to, with the consumer duty, looking at our client service. Do we have a different service for our decumulation clients compared to our accumulator clients? Do we have enough resource in place to deliver that service? How can we drive down those costs and provide value to our clients? Now, don't get me wrong, cheap does not mean value, and the FCA acknowledged this as well, but it's different needs, isn't it? As somebody's in retirement, their objectives, their needs are different to those accumulator clients. And of course, as I said before, is looking at our client communications. Just one thing while I think about client service, a lot of firms are starting to introduce an end of life guidance document. Sounds a bit morbid, but it can give clients peace of mind about, gosh, if something was to happen to me, this is what you need to do, for your wife or your spouse or whatever. And there's other software out in the market as well, where you can have a bit of a online locker service where you keep copies of your will and such like. It's just a nice added touch, and I think it is demonstrating to clients and to the FCA that you're thinking about that whole client journey and giving peace of mind and therefore value. Just food for thought, really. So the conclusion. So we don't know what the feedback from the FCA is going to be for this, but what I would say quite confidently is that we should have a documented strategy for our decumulation clients. What you don't want is the FCA saying, well, the objectives of a decumulator client is different to an accumulator. How are you addressing this? And you'll be going, of course I know it is. And I treat them all the same. I use exactly the same fact find for both processes. And the FCA says, but why? They're totally different stages in their life. Now, you could have the answer, and that and it could be something really quite straightforward, which is good, but make sure it's documented. Now, if you get challenged by the FCA, you don't remember what I said earlier. You want to be able to whiz off that document to the FCA straight away to show that you're efficient. You've thought all this stuff through. You've thought about sustainability risk and withdrawal rates, and this is the logic behind it. The FCA. The FCA, when you're looking at investment strategies, don't care which investment strategy you use necessarily. They don't care if you're active or passive or blend, if you use a DIM or not. What they do care about, though, is that you have thought through the process and you can evidence the conclusions that you've come to. And so, therefore, if you are of the Nick Murray view, where we're using just cash and equities, how is that being effectively communicated to clients so they understand all the risk and how you're accommodating all this? If we are doing percentage charging, and we're supposing we're charging exactly the same for our accumulator clients as our decumulator clients, it's 1% all the time, fine. But how do you justify that to the FCA? What change in service is there to accommodate for that decumulator client? Basically, it's making sure that you have thought all this through and you have the evidence to back up your thought process. So that is it. That is me. That is a session. I hope you got something out of that. If nothing else, some food for thought. Enjoy.
And last but not least, take up the final few minutes of the webinar is our Investment Business Development Manager, Andy Adshead. Andy will discuss a variety of at-retirement solutions taking into consideration volatility bands and risk. This insightful session should help you evaluate your current solutions and check whether they work for you and your clients, whilst taking into account regulatory considerations.
Hi, my name is Andy Adshead. I work for the investment team, Business Development Manager for the North, Scotland, the Midlands and Northern Ireland. I may be a familiar face to some of you by now, hopefully. And if not, welcome to the On the Road webinar. I'm just going to talk through, I guess, the gel, if you like, or the where we've ended up after the sessions that you've been going through so far. So some potential solutions, hopefully during the course of the last few sessions, you've been thinking about specific clients, or maybe even about your own portfolio and what you're going to do in the retirement space. So in order to try and frame this better and to make sure that we articulate accurately what we're trying to achieve from an investment perspective at AJ Bell, I just want to talk you through some of the psychologies, I suppose. So anxiety level 1, you've probably been thinking about the anxiety level of different clients over time. So anxiety level 1 is probably at the top of that pyramid there when the client's got the most to lose. So it's quite easy to be brave, I guess, in the accumulation phase when you've got no money in the pot and you're paying in regularly and you're young and you've got plenty of time. It's probably quite easy to be brave. Although those young investors can get knocked off course, so if they lose money quite quickly, their anxiety can rise, and keeping the client on that journey of accumulation probably is super important. But these clients, when they've got the most to lose, clearly they don't want something that's sort of out of the blue right there, so they're trying to hope that you can manage the downside, I guess, for them during that phase. And then obviously as they go through their crystallization journey, however long that may take, it might take them 20 years to fully crystallize, depending on the value of the pot. And then we enter the what I'd call anxiety level 2, which is the true decumulation phase. So I guess, what do we do in the accumulation phase to help? So what you can see there, you can see these gold risk targeted banners from Distribution Technology, and we map to other risk profilers. So don't see that as an issue. It's just the fact that we've got this risk targeted process. So basically there's a framework inside. And what does it mean to the end client? So if you point your eyes down to those volatility bands, so essentially the volatility bands, so rounding them up, 4 to 6, 6 to 8, 8 to 10, 10 to 12, and so on. As you start to take more risk, and the client's filled in the risk profile questionnaire, I guess, with different thought processes in mind. So if they've ended up in DT7 or DT8, they pretty clearly appreciate that they're aiming for substantial returns and they're aiming for growth. But those people who've filled in the risk questionnaire and they've come out as a 3 or a 4, what's driving their psychology? So what's driving their decision making? It's probably the capacity for loss. It's probably the inability to want to lose money or the fear of losing money. And therefore, these volatility bands that we're aiming for is about what assets we put inside to try and hit those bands over time. So essentially what we're talking about is managing the journey. So where could you use these solutions? Clearly, you can use them in accumulation. And for those of you that sit there with a total return in mind process for decumulation, then what a great fit there when you've got a strategy that's trying to manage the journey. Okay, so you could ask, well, okay, so it's quite brave then to set these volatility bands up, and the last 2 years has been quite a significant time, particularly for lower risk clients. So how have you managed to manage to those volatility bands? Or I guess the question raised would be, have you managed to keep within those volatility bands? And hopefully you can see there the red dots that you can see against the sectors, but more importantly against that annualized volatility. So in at 6, in at 8, under 10, which is what we want to see for the first 3 dots. So 6, under 8, under 10. And then the next 3, probably a bit light in terms of volatility, the top right side, but that's just a function of global equity over time. So equities have been lower volatility than perhaps we would expect, and that's therefore had a consequence to those portfolios. But where we've been concentrating, I guess, the challenge in the last couple of years has been for those lower risk clients, and you know that probably better than I. So what has that meant in reality? So that biggest challenge, that lowest risk client, the one that had the most fixed income, the one that was most interest rate sensitive as interest rates started to rise, what does that journey look like? So the red line you can see there is how we've managed that downside. So when we refer to drawdown in IFA land, you normally mean taking withdrawals. When we refer to drawdown in investment land, we're talking about the peak to trough losses. So you can see there that we've managed to manage that downside, even for the lowest risk clients, pretty well. The sector average, of course, the grey line, and we're part of that sector. So you can imagine that there are plenty of solutions that are underneath that grey line. Now, they may, in fairness, have said that they weren't going to try and manage the journey, they weren't going to manage the downside. We're saying that we are, and that's probably, I guess, an example of our cure for anxiety 1. So those clients that are approaching retirement, or the younger client that's investing for the first time, or simply people who, with the aid of technology, are logging in a little bit more to see the value of their investments. So that's the total return solutions. As I say, can be used in accumulation, decumulation. What else do we do? So you're probably asking yourself, well, what else have you got in the locker? Okay, so income portfolios, these are slightly different, and they're not targeting a level of risk, they're targeting yield. So as you can see on screen, they're targeting a yield naturally between 3 and 5%. If you're looking at the charts on the right hand side there, you can see passive, active, and the CDOL coded fund range. We would expect the active MPS to have slightly higher yields because you've got active stock selection as opposed to a broader basket of the indices. So that gives you an understanding that we're hitting our targets in terms of yield. Where do people use these portfolios? In the main, in the decumulation phase, but let's not get too fixated with that. Of course, you've got general investors and you've got people that are investing in ISAs, and of course, all of these portfolios can be appropriate to that tax wrapper. So we were talking about anxiety, so I guess managing anxiety 2. So managing anxiety 1 is when I've got the most money invested, I'm pre-retirement, maybe entering that crystallization phase. What does managing anxiety 2 look like? So we can see there the 2 dips on the roller coaster. This is probably when I started to take withdrawals, which has been the main body of this session today. So what are the cures for that? So there are obviously lots of things that you could do, and perhaps stress relief 1, so anxiety relief 1, considering somebody's capacity for loss with the change in interest rates, maybe an annuity is part of their overall proposition. So what we refer to as their heating and eating, so the basic living and expenditure costs, could that be covered by an annuity? And that of course will be different for all clients, but that's probably the first consideration to manage somebody's anxiety, to give them some form of guaranteed income. What's stress relief 2? So stress relief 2, we feel, is to bucket this solution. So here, this is one example, something that we run that's a purpose-built proposition. So we bucket these solutions, we give the client quite a high level of cash at 10%, and then we distribute the rest of the assets between growth assets and more defensive assets. So why the 10% in cash? That's to cover them peak to trough. So we're thinking as the client starts to take withdrawals and they're spending from cash, obviously what we don't want is a market downturn to occur there and then the client spent the cash that they hold. So we want to make sure that when, obviously the timing never goes right, does it? So the timing goes wrong and the client starts to spend some of that cash. Have they got then enough left to cover them through a period of market fall? So bucketing first. What comes next then? So we then feel that using that bucketing strategy, we can then produce a natural income, and then the natural income comes from the growth assets and the defensive assets, and clearly tops that cash-like reserve up. So the yield feeds into the cash-like reserve in order to be paid out to the client. So this is an advantage in keeping the entire client's portfolio liquid. So when they come to you and say, I know we set up our plan and we've got X amount of pounds that we're going to draw out, but something else has occurred, and can I just have X pounds, so 3, 4, 5, 10,000 pounds, I don't know, whatever the number is. And of course, they're not really asking you for that money. They're probably telling you that they've already spent it. They're not saying, could I have? They're probably saying, look, I'm on the hook for this capital withdrawal and I need it to be spent. So one of the biggest challenges, I guess, for IFAs is managing the whole strategy. Okay, so what we do is we do this smart rebalancing process. So I want to explain that in a way that helps you in terms of your administration. So who does it help? So this cash reserve that we hold, that's kind of a cap and a collar to it, and that we're trying to say, right, we're going to set you up at 10, but if it falls to 4, then we're going to take action. So when we take action, that means we automatically rebalance. So we rebalance the two assets that you can see on the left-hand side, the one that's got real assets inside. We'll look at those, and we're gonna make sure that we ensure that the client's got enough cash in their cash account to pay their withdrawals. So the automation of this process is really, really key. Who does a solution work for? So of course it works for people, as I said originally, in SIPs, ISAs, and general investment accounts. So if we were running a little summary for this proposition, it would be as such. So it's pretty simple to understand. You've got 3 buckets. It gives the client some peace of mind that they've got enough cash in their portfolio to spend in the short term. We're trying to manage the cost down. Of course, that's been something that AJ Bell across all our product ranges have been trying to do over time. And it's protecting against sequencing risk. So it's protecting against sequencing risk using that yield bias to then manage the cash position. So what's in it for you guys, the advisor? So does it lighten your administration burden? Well, that's the proposition in a nutshell, really. So they've got this auto rebalance structure, this managing cash position where we deal with all of the trading inside to ensure that the client's always got liquidity in their portfolio. It's a great solution for lower value drawdown solutions. So if you think about your profitability, so when you're dealing with clients who've got plenty of money, that's great. When you're dealing with clients who've got plenty of money where the fund isn't then growing and they're starting to have a little bit more of your time. So anxiety level 1 comes pre-retirement, anxiety level 2 comes when they start to take withdrawals. They clearly want a bit more of an arm around the shoulder and a bit more of your time, and of course you want to provide that for them. So in terms of whether the solution that those end clients are then as profitable for you, they're probably not. So they're probably taking up more of your time and less money that they're going to be providing for you on an ongoing basis. So more time, less margin. So having a solution that's scalable, having a solution that's great for low value pots. So the clients have got maybe under £200,000 where you're spending more time and you don't really want the extra administration burden as well, probably works quite. Okay, so a little summary. We've got IFA firms that I look after that stretch from Norwich to Inverness and across to Belfast, and some of them say, in this accumulation phase, it's great that you've got a risk targeted proposition. It's great that I can talk to the client about managing the journey. That's brilliant because it means the client will remain invested. So when I'm talking to them about cash flow, or I'm talking about their goals, I can try and ensure that whatever the risk profile, we're going to keep them invested. Of course, then we've got these income portfolios that we talk about, so an MPS solution and a CDOL coded version as well, 2 different risk profiles that are targeting yield, and then a range of cash solutions. So the recently launched money market MPS, then we've got the platform cash, the cash that simply sits on platform, or a range of money market. Okay, so in summary, how can we help? Accumulation, the approach to retirement, these risk targeted portfolios, and then in decumulation, you've either got this purpose-built retirement portfolio service that manages all the administration for you, that's yield biased to try and get rid of some of the sequencing risk, and has its bucket strategy to ensure it's liquid and there's a high level of cash. Or you can start to build your own bespoke solution, and we would love to chat to you about how we could put risk-targeted total return portfolios in those different buckets so that you can then produce a solution that suits you and your firm and, of course, your clients. Okay, that's all from me. Thanks very much for dialing in. Enjoy the rest of your day.
Thank you, Andy. If you'd like to hear more on the range of investments and management portfolios we offer, please let us know on the feedback form at the end of the session or add a note in the chat now. So that concludes our webinar for today. Should you need to contact me or any of the speakers today, please drop your details in the comment section on the automated feedback form and we'll get in touch very soon. Just a reminder that your CPD certificates and a copy of the slides will follow via email in the next few days. We have a few online sessions this week for various regions, so please bear with us and we'll have your follow-up items over to you soon. So that is all left from me to say thank you very much for joining us today, and we hope to see you at the next session. Bye for now.